Let's bring in Ann Sonders. She's Chief Investment Strategist at Charles Schwab. And I know you've been writing about inflation recently, Ann, which I do want to talk to you about. But first, I do want to ask about cryptocurrencies. And I'm not going to ask you if I should buy Bitcoin or people should buy Bitcoin.
Please don't.
But rather, what I'm curious about is something we were just talking about a few moments ago, which is maybe contagion isn't the right word. Maybe it's too strong a word, but spillover. You know, as Miles pointed out earlier in the show, a few years ago when we saw the big Bitcoin sell-off, didn't really affect much else in the market. Today, right, it seems to be. Is that something that you're at all concerned about?
So I do think it's a factor. And I think one part of Bitcoin in particular, not necessarily every other crypto, is a concentration issue that I don't think gets the attention it deserves. And you know, we can look at percentages. And what I mean by that is the top 2% of holders of Bitcoin own 95% of the market value. And that's sort of the part of the thesis behind the Ponzi scheme view. I'm not suggesting that's my view, but that's often what is mentioned, versus 75% of Bitcoin holders have less than $600 worth. And those stats I saw a month or two ago when we were much higher level. So yeah, I think the carnage is more because there's been so much more adoption, especially by the retail world. The question is, how big of a hit? Really, what I think is going on is this is just the next sort of micro bubble, as I've been calling them, to get pricked. We've seen it in other highly speculative, in many cases, arguably low quality segments of the market, heavily shorted stocks, weak balance sheet companies, non-profitable tech, other spec areas. And for a while there, cryptos was sort of the haven that wasn't succumbing to those rotational bubble pricks until recently.
And, you know, Lizanna, against that backdrop, are you surprised with how well, and I mean, like, the NASDAQ is, I think, what, 5-6% off its record high. Are you surprised with how well the major averages have held in with, you know, the meme stock boom kind of coming and going, SPACs coming and going? Now crypto is the part of the story. How does that kind of shake out to you in terms of the strength and the quality of this, you know, still intact rally?
Well, I think it reflects that the rotational nature of the market into the beginning of this year shifted to those arguably more arcane, lower quality segments of the market. When we first saw the rise of the newly minted retail day trader last summer, most of the speculation among that cohort was in the leadership names, in the big five, in the FANG type stocks, which is why what they were doing wasn't as noticeable, because it was all mixed in with the otherwise leadership areas of the market. It really wasn't until January of this year that you saw that speculative froth move into those higher risk, lower quality, outside the mainstream parts of the market. And I think that's part of the reason why the major averages have been more resilient. First of all, in an index like the S&P, when you've got 50% year-over-year earnings growth in Q1, 60% expected in Q2, that's obviously helped bring the multiple down by virtue of the denominator doing a lot of the heavy lifting. You certainly don't have that force in an index or a segment like non-profitable tech, et cetera. So it doesn't really surprise me. I think what we're seeing is that, yes, when you have an unwinding of some of the speculative excess, it does hit the major averages to some degree too, but to see much more carnage in the SPACs and cryptos and some of those other areas that I mentioned, that's where the froth was most rampant.
Lizanne, staying on the point you just made on multiples, really enjoyed the tweet you put out this morning noting the price to sales ratio for the NASDAQ is off its peak, but the S&P 500 and Russell 2000, their price to sales ratios have stayed pretty consistent. I mean, do you think those two indexes are next for a valuation correction?
Well, I think we're already seeing it within every index. We're seeing it within the NASDAQ, within the S&P. You're seeing that shift more toward a value factor bias. I'm not talking about the indexes of growth versus value, but the factor of value, whether you look at free cash flow yield or price to book or price to sale, those stocks that rank well on those value factors have been outperforming those that rank well on the growth factors, even within segments of the market or sectors of the market that are much more growth oriented. So I think that's what's happening. You have to look under the surface to see this re-rating that has happened, driven by inflation pickup as well as fears that it'll get worse before it gets better looking ahead. So I think you have to peel the onion back a little bit to see what's going on in terms of the inflation impact on this re-rating.
Liz Ann, good to see you. Thanks for being here. Liz Ann Sonders
My
is
pleasure.
Chief Investment Strategist at Charles Schwab.